Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden in plain sight, especially when it comes to how companies manage their money and what that means for you and me. Today we are diving into Ralliant Corporation's latest filing, and let me tell you, it is all about money, or rather how they are making it cheaper to borrow money. Stick around to find out how this could impact their future plans. Before we dive in, if you love getting clear, no jargon breakdowns of these complex corporate documents, hit that subscribe button. And for a deeper dive and to chat with fellow finance enthusiasts, join our Discord community. The link is in the description below. Alright, so what is the big news from Ralliant Corporation? It seems they have made some significant changes to their borrowing agreements. Think of it like renegotiating your mortgage or a car loan to get a better deal. Specifically, they've entered into an amendment to their credit agreement, which is essentially a fancy word for their big loan contracts. What does this amendment actually do? Well, the most important punchline is that it makes borrowing money cheaper for Ralliant. They are reducing the interest rate on their credit lines and loans. This 0.10% drop might sound small, but in the world of corporate finance, even a tiny reduction in interest can save a company millions of dollars over time. This is crucial because it means they will have more cash available to reinvest in their business, perhaps for growth, research, or maybe even to return to shareholders. Another key change is that they are essentially closing out some of their existing loan commitments. They are taking down the amount of money they could potentially borrow but haven't yet. This is like deciding you definitely don't need that extra credit card limit anymore and telling the bank to remove it. For Ralliant, this eliminates a fee they used to pay on those unused borrowing amounts, which is another way they are saving money. It also suggests they are confident in their current cash flow and don't anticipate needing that extra borrowed money in the immediate future. So why is this all happening? It's likely a combination of things. The company might be in a stronger financial position than before, making lenders more willing to offer better terms. Or they might be trying to proactively manage their debt costs as interest rate environments change. We also see that this amendment was made on the 24th of November 2025. So it is quite recent, and the original agreement was signed back in May of 2025. This shows a quick move to optimize their financial structure. Ralliant Corporation's main stock is traded on the New York Stock Exchange under the ticker symbol RAL. This is the stock that many investors, including potentially ourselves, follow when a company improves its financial flexibility by lowering its borrowing costs. It can often be a positive signal for its stock performance. It suggests smart financial management and a more stable outlook. Looking at the signatures at the end, we see Teo Osben, the Chief Accounting Officer, signing off on this report. This tells us that the company's accounting leadership is directly involved and confirming the details of these financial agreements. It adds a layer of official confirmation to the changes being reported. Now let's put on our Warren Buffett hats and think about what this means. Lowering borrowing costs directly boosts a company's bottom line. It's like finding a discount on your rent. This freed up cash can be used for many things. Perhaps they'll accelerate their expansion plans, invest more in developing new products, or even make strategic acquisitions. On the flip side, reducing undrawn commitments signifies a current lack of need for external financing, which could indicate stable or even slowing growth expectations in certain areas, or simply a very efficient cash management system. It is a double-edged sword of sorts, showing financial health but potentially hinting at a current strategy that doesn't require aggressive external funding. Looking at the bigger picture, Ralliant Corporation seems to be actively optimizing its financial strategy. They are reducing their interest expenses and eliminating unnecessary fees. This demonstrates a proactive approach to managing their balance sheet. The key risk here, if any, is whether this move signals a lack of ambitious growth projects on the horizon that would require additional capital. However, without seeing the full financial statements beyond this specific amendment, it's hard to say definitively the opportunity presented is clear. More cash flow for strategic initiatives. In conclusion, Ralliant Corporation's latest filing signals a move towards cheaper debt and improved financial efficiency. This is generally a positive sign, allowing the company to operate with a stronger financial foundation. Well, be keeping a close eye on how they utilize these savings and what their next strategic moves will be. Alright, that is our breakdown of Ralliant Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think lower borrowing costs will fuel more growth, or is it a sign of cautious strategy? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.